Hey traders, for today's trade, we're looking at a covered call strategy on a recent IBD stock of the day, ELF. ELF rose 85% over the last year, while the S&P 500 suffered serious declines. Taking a look on MarketSmith, shares had a nice jump in Friday's market, clearing a 57.02 buy point from a 5-week flat base. Volume was well above average, supporting a strong breakout. ELF also joined IBD's leaderboard on Friday. The stock rose about 75% after breaking out from its cut base at the end of July. Meanwhile, its relative strength line is at highs, a bullish sign on the breakout. Boosting the stock's year-long rally, ELF has posted a couple consecutive quarters of accelerated earnings growth, with EPS rising from negative 19% to 71% in fiscal Q2. Now, investors searching for yield can generate income on ELF stock using a covered call strategy. This is a very simple strategy designed to collect income while also defining a predetermined exit price at which you would sell the underlying stock. To set up a covered call, you'd need to first buy shares of the underlying stock, then become the seller of the call options on that stock, collecting income to offset your cost basis. As the seller of the call option, you're obligated to hand over your shares to the call buyer at the agreed upon price or the strike price if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. So let's take a look at my trading platform and set up a real-life trade using ELF. So here we are looking at ELF on my thinkorswim dashboard. To set up this trade, if you're using thinkorswim, you're going to want to select single as your spread type here in this box. Then you want to make sure you are using the February 17th expiration. Looking at our strike prices down here in the middle, we want to use the 60 strike. And look at the side of the screen for the prices for call options. And so to recap this very simple trade, we are looking to sell one February 17th expiring 60 call. So for this trade, a February 17th expiring 60 call option can currently be sold for around $2.95. This would generate $295 in premium per contract. ELF does not currently pay a dividend, so generating $2.95 from covered call writing in only 1.5 months is pretty attractive. The $2.95 received in premium also gives a small buffer on the downside of roughly 5%. That means that the stock could trade about 5% lower between now and the February 17th expiration, and the covered call trade would still break even. The total capital at risk in the trade would be $5,510 if ELF went to zero. That's how much the trade would lose. But you'd certainly aim to close out your position long before losses that high ever accrued in your account. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to join us for our regular options content where we discuss new trade ideas like this every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.